Hopefully it connects. That would be a problem if it doesn't. Good afternoon, everyone. Come on in, make yourselves comfortable. We'll get started in about 30 seconds. Good afternoon, everyone. We'll get started in a couple of seconds. Got a few more people waiting to join. All right. Welcome to our special event webinar this month on what's happening with global banks who have been making a lot of headlines in the last few weeks. My name is Jeff Thurecht. I'm a director at Evalesco and Australian Advice Network, and I'll be your host today. We're very fortunate today to be joined by Brett Mesurier from Senior Equities Analyst at Perpetual. Thanks for joining us, Brett.
Oh, my pleasure.
So in Brett's role, he is responsible for the financial sector. So he's extremely well positioned to take us through what's been happening with the banks over the next 45 minutes or so. So just before we get into today's conversation, I'd just like to let you know that at home you are on mute and your cameras are turned off, so we can't see you. But we would love to get your questions as we go along. So please use the Q&A box down the bottom of your screen to type in any questions that you have, and I'll have a look at those as we go through and ask the questions to Brett. We'll come back to them at the end, time permitting, of course. Also, I want to let you know most of our conversation today will be about general investment markets, a couple of specific examples, but not personal advice. So I'm giving you a general advice warning disclaimer to remind you that what we're discussing today is of general advice only. We don't know your personal circumstances as we're having this conversation, so we're not going to be giving you personal advice. But if you would like to know more, please get in touch with your advisor or with me, and we can talk about that in more detail. So we'll get into it. So as we said, we're talking today about what's been happening with global banks and should we be concerned. So just a very quick recap on a couple of the sort of high profile incidents which have happened over the last couple of weeks. The first one was Silicon Valley Bank, which was a fairly large regional bank in the USA, even though one that not many people had probably heard of. And you know, I certainly hadn't heard of it until the headlines on March 9. So that bank collapsed and defaulted on its deposits and loans. It's been placed into receivership and is now under the control of the US Federal Deposit Insurance Corporation. And they've said that they will pay out 100% of the bank's $21 billion of insured deposits to protect the consumers there, which is a great result for consumers. Perhaps we can talk about whether that's the right result for, you know, financial systems or not. Then the following weekend, we learned that UBS had acquired 100% of Credit Suisse. So Credit Suisse is probably a name that many people had heard of, a fairly large, well-established, long-running and fairly prestigious Swiss bank. That move for UBS to acquire Credit Suisse was supported or maybe even encouraged by the Swiss government to avoid a potential collapse and protect consumers there as well. So that was a couple of weekends ago now as well. So since then, there have been a couple of other smaller events and lots of talk about what's been happening. And I've been reading a lot about this, as I'm sure many people at home have been through the papers and watching the news. And I've got to say, I've probably got as many questions as I do answers at the moment, which is why it's great to have Brett here to run us through and hopefully answer a lot of those questions. So start off with Brett. How did we get here and what happened with those sort of high profile banks?
Yeah, well, let me start with Silicon Valley Bank. I mean, that was an extraordinary outcome and extraordinary bank. It was managed poorly, I think, is fair to say, and managed poorly on a number of fronts. They had a concentration of deposits, which is what our banks seek to avoid, and basically well-run banks seek to avoid, for obvious reasons, as we've seen the disadvantage of that. They also had a large proportion of investment securities on their balance sheet, which were not marked to market. And when you looked at their accounts at the end of December, the unrealised losses on those were roughly equal to their capital. And so that was on a pre-tax basis versus after-tax capital, of course, but nevertheless give you a sense of the order of magnitude that they were looking at. They were effectively looking at, if you mark it to market, substantially wiping out their capital. And why they had, the reason they had such substantial losses was because they didn't hedge the assets, the investment securities that they bought. So they basically didn't hedge them into floating rates, such that when interest rates went up, the value of those securities fell materially. And by materially, I think I'm right in saying they fell around 20%. Which is quite different to what our banks do, because they largely run floating rate books. It's not entirely floating rate. They make decisions as to how much they will keep it fixed and how much they will leave it floating. But in the case of Silicon Valley Bank, they didn't hedge it. They just ran the interest rate risk. There's an interest rate risk and, of course, a credit spread risk. Of the two risks, as it turned out, of course, the most material risk was the absolute level of interest rates, not so much the credit spread risk.
So just on that, so the difference there, the fixed and floating, or fixed and variable, as we would sort of call it here. So they were lending the money on a fixed basis. Is that right?
No, I'm actually referring to the investment securities that they had. That was the key difference between how our banks are operating and how they were operating, and also how our banks do it. This is how they do it with regard to their securities. So our banks substantially have them marked to market and go through their capital. And the extent to which they're not, they have to hold capital against that anyway in this capital calculation, interest rate risk in the banking book. So our banks don't run the same risks that they ran, and in fact, no bank should have run that risk. Well, as you can see from the outcome, they shouldn't have been running that risk. And so what happened then, because they had a concentration of deposits, it didn't take much for a few, I think they were tweets, to go from one major depositor to another major depositor, and out in the wide world, and we're taking our money out. And so it began the run on the bank, which then means that those unrealised losses become realised as the securities are sold to repay the deposits, which then has adverse consequences on their capital. And so it snowballs. And they're gone.
And you said concentration of deposits as well. What do you mean by that?
So they had a few very large depositors, which makes them more vulnerable to a run. Whereas our banks have a broad spread of depositors. So less vulnerable to a run, plus a much greater proportion of our depositors would be subject to the government guarantee. Effectively. Because they have much smaller balances typically than they did with the Silicon Valley Bank. And of course, Silicon Valley Bank had to be dealt with quickly because many of the startups in Silicon Valley had to pay their salaries out of the deposits that were with Silicon Valley Bank. And the directors are personally liable. The directors of the bank, I think, are personally liable. And the individual companies personally liable for payment of salaries. And therefore, something had to be done. And so there are a couple of reasons for action happening. And then in the case of, just moving on to Credit Suisse, in the case of Credit Suisse, it wasn't as bad as that, being a much bigger organisation. And on the face of it, the risks were better managed. However, the organisation as a whole was poorly managed. And so shorts are effectively enthused from the success in Silicon Valley Bank, go looking for next, right? And you would say the worst run large organisation was Credit Suisse. And by worst run, I mean from an ongoing profit perspective.
Right.
Well, there wasn't any, actually. There wasn't any in 2022, there wasn't any in 2021. And in particular, the situation got worse from the third quarter 22 to the fourth quarter 22, when they actually reported substantial trading losses in the fourth quarter of 22, which I think were of the order of 600 million Swiss francs. They were also losing deposits, and that accelerated in the fourth quarter of 22, but it had been going during 22. And as I said, inspired by the success of getting rid of Silicon Valley Bank, the shorts go looking for who's next. Shorts both on the equity side and also on the debt side as the credit spreads move out. And that has also consequences more broadly as to the lines that other banks have with Credit Suisse. Do they actually want to deal with Credit Suisse? And that then creates the necessity for the Swiss government to do something about it, which they engineered.
So UBS then came in and took over 100% of Credit Suisse, and so that was, as you understand it, at least in part driven by the Swiss government's involvement in looking for some way of engineering a bailout.
Stabilising the situation, yes.
Primarily focused on protecting the consumers and
the broader financial system, which one way or another goes through the whole economy.
So that leads, I guess, to the next sort of question is, those issues, as I sort of touched on in my intro, there's been a couple of other, smaller banks or other little ructions happening. So are these banking issues constrained, or are we likely to see them become more widespread? And
I find it hard to believe that Silicon Valley Bank, I think Signature was the other one, New York, had those sorts of structural problems on their balance sheet. I find it hard to believe that it's actually limited to them. I would imagine, not that I've done a detailed review of this, but I would expect, given that there's so many small banks in the US, that there would be others in, you might say, tricky situations. I would be surprised that they would be as bad as Silicon Valley Bank, but nevertheless, pressure would be on them. So it wouldn't surprise me to see more smaller banks be taken over, basically.
So you think it's more likely that somebody will be opportunistically taking them over as opposed to more collapses?
I think that's what's the likely outcome. That's right. They'll see well-run banks put themselves in a situation where they can benefit from tougher times. And we've seen that before in our own market, right? We've seen smaller regional banks being taken by the major banks as a consequence of the GFC. There's a number of those. But the current situation is different to the GFC, and we don't have the same concern on the part of the banks when they look at each other as to whether or not they're safe. And I'm talking about the larger institutions. Whereas in the GFC, it substantially froze, lack of trust disappeared. They didn't know who was next. They didn't know who had all these horrendous exposures. Whereas, which was really a credit event, whereas this is an interest rate event rather than a credit event. So this goes to managing your balance sheet as opposed to the credit risks that you're taking.
So what do you mean by that?
So if you may remember, what kicked off the GFC was a whole bunch of mortgage loans falling over in the US, and they'd been securitized, packaged up and distributed out to a number of banks and a number of investors, not limited to banks, of course. And we know that Lehman, remember, had an unfortunate concentration of these sorts of risks, which brought it down. Whereas that's different to, so that was a credit event. Whereas this is about the absolute level of interest rates and the quick change in that.
Yep.
So that was a credit event, which was always going to happen. It was this question of when, given the way the US was operating on mortgage loans, being a securitization of them, and the poor underwriting standards. Whereas this is just a response to not positioning your book properly, not hedging yourself, so you can respond to a rapidly changing interest rate environment. Because all our banks, well, if you're a well-run bank, you would see the interest rates were going to go up. The only thing you didn't know is how far.
Yep. Okay. So my understanding is in the US, there are many regional banks of similar sort of structure, maybe better run than Silicon Valley Bank and Signature. And for them to collapse is not that uncommon.
No.
It happens from time to time and or they get bought out when they're in distress.
That's right.
Whereas Australia's system is quite different.
Yes, that's right. That's right. Although, you know, going back to the GFC, we had a few in distress and were taken out.
Yeah.
But we have the strength in our major banks that and they're so much larger than any smaller ones that might get into trouble, that it's an easy solution.
Yeah. And then with Credit Suisse being quite a different proposition to the regional banks in the US, you mentioned the short sellers. I read this week that, you know, some of the short sellers that had moved on to Deutsche Bank as one name that sort of popped up.
Yes. Yes, the usual suspect.
Are they?
Yes, they had been poorly performing for a long time as well, but they recovered substantially, and by recovering, I'm talking about profit, recovering substantially in 2022.
Right.
And for the first time for a while, met their cost of capital on their returns.
Okay.
So I would say they managed to get themselves in order just in time.
So they're in this position strong enough to...
I would think so. I would think so. They would be strong enough to get through this.
And is there any other usual suspects that you think?
No, that was as soon as I heard Credit Suisse, I immediately looked at Deutsche.
Yeah. Yeah.
That's right, amongst the large banks.
Right. So, as you said, Credit Suisse has been underperforming for a number of years and potentially were, you know, in a little bit of distress anyway.
Yeah, they were vulnerable anyway.
Yeah.
Yes.
And so that's not...
And when the pressure comes on, the weakest get taken out.
Yeah. So that's not necessarily a widespread phenomenon.
No. No. And when you look at their performance, you know, relative to our banks, for example, is way below our banks. All our banks are meeting or more than meeting their cost of capital and have done it for quite some time, on a regular basis. They also manage their risks extremely well. They spend a lot of time on it. If not inspired by the regulator, then inspired by themselves.
Yeah, yeah, that was what I was going to say. How much of our, I guess your confidence and our comfort with that is driven by our regulatory environment as opposed to, I guess, the US as a current example?
Yeah, well, there's no doubt that APRA spends a lot of time with our banks, which is very helpful for both parties. You know, it's good to have an intelligent external force having a look at what you're doing. And they do it in some detail. It's not a cursory look.
Yeah. And a lot of that strengthened through the GFC.
Yes, that's right. That's right. Yeah.
I think it's easy to have a short memory, but APRA probably has enough corporate memory that they're across those issues.
Yeah, and the major banks do too. I mean, the people in the senior positions at the major banks have been through a lot. And that's what you need.
Yeah. And so when you look at the Australian banks, which I know you spend a lot of your time doing, do you see any in a stronger position or a, potentially more vulnerable position when you look at how...
Not with regard to these issues of vulnerability to collapse. They're all in an extremely good position. So that's not what that's not what concerns me about them. What concerns me about them is the operating environment with regard to their margins and how they're going to go in the next 6 to 12 months on that. Because we've had a substantial increase in their margins as a result of increasing interest rate. Yeah. But those days may well be pretty much at their peak. And the question is, do they stabilise? Does it roll over? Or can they actually push on a little bit higher? And that will substantially depend on the competitive forces that exist in the home lending market and also the deposit market.
Just on the margin, so they've been able to grow their margins, but why is that the case? Because often we see when the RBA increases interest rates, home loan rates increase at a similar amount. Why have they been able to grow their margins just because interest rates are going up?
Oh, because they have been increasing the rates on their assets faster than they've been increasing the rates on their deposits.
Right.
So it's a simple, that's one issue. They also have a substantial amount of assets which are backed by equity. And of course, equity doesn't have an interest rate associated with it. So they benefit from the higher free float, you might say.
So when you say backed by equity, what do you mean by that?
By the NTA of the business, effectively, tangible assets of the business, which depending on which bank you're looking at, goes from 50 billion to nearly 70 billion.
Mm-hmm.
So they're substantial. So basically they're about 5%, give or take, of their average interest earning assets.
Mm-hmm.
So on the face of it, if you've got 3% increase in interest rates and you've got 5% with no associated interest cost, then on the face of it, you have 15 basis points benefit to your net interest margin coming through.
Mm-hmm.
And that comes through over a period of time because part of the management of their risks is that they put hedges in place for that. So that comes through over a period of time based on the length of the hedge, like the duration of the hedge.
Yep. And through the GFC, as you touched on, there was a bit of consolidation. Some of the regional banks rolled into some of the bigger banks. And are there any of those? I don't know whether we call them regional banks. I suppose we do here. Any of those out there which might be looking like in obvious need of some support, or obvious targets?
Yeah, I only look at the larger ones, larger of the regional banks.
Yeah.
So Bendigo and Bank of Queensland, for example. No, they're not. They're not vulnerable.
They're still going strong.
Strong enough. I mean, they have disadvantages on their efficiency side, which means that they, pretty much earn returns equal to their cost of capital, which means they trade around NTA. So they're reasonable, not fabulous investments.
Is that purely scale, or?
Yeah, substantially due to that. I mean, all the banks now have to have substantial compliance operations, which are expensive. Also, the ongoing progression in the improvement in IT generally in the bank is expensive. And if you've got a smaller revenue base, it eats into it.
Mm-hmm.
So the cost to income ratio is necessarily higher in the smaller banks than the larger banks. There's not much they can do about it.
Yep, makes sense.
It's just the way it is. And the higher cost to income ratio means the return on equity is lower.
Okay. So you mentioned that not concerned that they're vulnerable to collapse, but the operating model is the sort of area of concern. So what does that mean in terms of what you see as the outlook and how you are positioning?
So the outlook for the major banks. So the major question for the banks is which direction are the margins going, as I mentioned. At the moment, it looks like steady margins are the best outcome that we're going to get. So they look like they're steady to down, which is problematic from an investment perspective. Also, when you look at credit growth, we've had substantial declines in house prices, which is a major input to credit growth. So credit growth is slowing. Also, business credit growth is slowing. So when you think about the real top line of the banks, net interest income, while it's still growing, the rate of growth is slowing. There's not a compensating impact in fee income. It's not changing very much, maybe a little bit of growth now. Expenses are still feeling the pressure of the higher compliance spend and, of course, now higher inflation. So that's making it more difficult for them to reduce their cost to income ratio, which would improve the ROE and enhance the multiple. That's more problematic at the moment. So as you have slowing loan growth, downward pressure on margins, inflation impact, increasing inflation on expenses, you have the cost to income ratio unlikely to fall. In that, you also have, just to complete the picture, likely rising bad debts. We've seen them increasing slightly. There's no great drama there at the moment, but that's moving up, which also is a compounding factor.
Is that mostly in the home loan sector or more business?
No, it's not coming in home loans. The rate of loss on home loans is extremely small. I think I'm right in saying that I was looking at Westpac the other day. I think they lost about $10 or $20 million on home loans in a quarter. Last quarter, I think it was $10 million in the last quarter. And in the last year, it was something like $30 million they lost. Whereas if you compare that to the losses on unsecured consumer credit,
right,
you know, they're about 6 times the size.
Okay.
And if you compare the size of the books, like Westpac's home loan book is, you know, $500-600 billion, and the unsecured personal credit is just a fraction of that.
Yep.
So the loss rates are much higher, not surprisingly, on unsecured personal credit, and they provide a much larger contribution to the bad debt charge than housing. So the delta is really unsecured consumer credit and also corporates is where we'll see it. I don't expect to see much in the way of losses in home loans. I mean, even if they double, they would still be a small proportion of the total bad debt charge.
So I guess that's an interesting area to often comes up with the, you know, we're already seeing some decline in housing prices with that, you know, so-called fixed rate cliff coming to home loan rates.
Yes.
That's not an area that you are concerned that anyone's exposed to overly when that kicks in?
The will unquestionably lead to higher past due loans, higher non-performing loans. But there's two elements to a bad debt. There's the incidence of default, and then there's the loss given default. So the incidence of default will probably rise. The loss given default will probably continue to be extremely small.
So what's that mean? What's a loss given?
So once you have a default, once you have to do something about it, realise the asset, how much do you actually lose?
Right.
So, you know, notwithstanding the fact that, you know, the average LVR on the whole portfolio of the bank is probably in the 40%, which would imply, you know, no loss.
Yeah.
Obviously, you worry about the tail, where there is some, nevertheless, percentage above 90% LVR. So there will be some losses, but they will be small. As I said, relative to the size of bad debt charge. To put it in context, a bad debt charge from a major bank, except in really adverse circumstances, is typically of the order of $1 billion a year. So given what I was talking about before, the losses on home loans, you can see that even a doubling of the current rate doesn't have much of an impact.
Yeah, okay. That's good news.
Yes. Yes, so that's not really the issue. I don't think the issue on the refinance side is the impact it has on margins, because you've got so much of those fixed rate loans coming due. That's going to be a point of looking at whether they should stay with their current borrower or move on.
Yeah.
And so there will be what happens in that negotiation is going to have a material impact, I would think, on the net interest margin and therefore the top line. I think that's more the issue than asset quality.
So even though margins have increased for them potentially since those fixed loans were written, because they're in a competitive situation, they might have to squeeze the margin to keep it, or...
I think a better way of saying it is that those fixed rate loans are actually written on fine margins. The banks had previously been expecting that the refinancing of that and the movement from fixed to variable would have given the banks an opportunity to increase the margins on those loans.
Okay.
That opportunity is looking like it's not very large.
Yeah. Okay. That makes sense.
Which goes to the flat to down trajectory, right, as opposed to materially down. I don't think it's materially down.
Okay. So having said that, how are you positioned? What banks are you owning? What are the opportunities?
All the major banks are in a similar position with regard to margins.
Mm-hmm.
There isn't a standout bank which is most likely to have a better margin outcome than the others, and it's not surprising because the major variable is on the retail side. And notwithstanding the fact that Commonwealth Bank is the largest retail bank, ANZ, the smallest retail bank, still has a very large proportion of its business coming from retail. Right. Home loans still impacted significantly. So it's more a sector issue than a specific bank issue. So the outlook for the banking sector, I think, is unquestionably, not as rosy as it was 6 to 12 months ago. Right, as interest rates started to increase. I'm very enthusiastic about it in the second half of the calendar year. I'm not so enthusiastic about it these days, but I could be wrong. They could, they could have a new sense of need to maintain or improve their margins, just as they had before. But at the moment, that's looking problematic.
How would they do that?
To wait and see. Well, it's simply the rate that they're offering new loans at. And, most loans these days are written through a mortgage broker. So it'll be pretty easy to see what's going on. And you'll know pretty fast.
Yeah. Okay. So are you looking at reducing your weighting of your portfolios to banks, or sort of writing it out?
I would say I'm looking very closely.
Mm-hmm.
I monitor it very closely all the time as to what's going on, as you might imagine. Talk with brokers quite regularly to find out what they're seeing. Also, some of the banks report in some detail what their rates are, so I watch how they move. So it's a continual source of intrigue, and watching is the way I describe it.
Mm-hmm.
So we also need to bear in mind, I don't want to be too bearish on the banks, because you've got to bear in mind that they are still, the EPS is still going to have growth. The EPS maintains its upward trajectory. The multiples that they're on are still reasonably low.
Mm-hmm.
The dividend yields are really quite supportive.
Mm-hmm.
So, they're all reasonable investments.
Yeah.
Major banks in particular, and the regional banks, get dragged along.
Yeah. Are there any that you prefer or think you would be more keen to be holding at the moment than others, or you think they're all in a similar stage?
Yeah, they are. They are. It's, the bigger question is, the sector. How's the sector going? Which is what I was describing. So it's doing okay. I'd like to see it doing better. Basically, is the answer. Yes. Okay. I think that's it.
So we've got a few minutes to go. So at home, if you have any questions, now would be a good time to pop those into the Q&A box, and we can have a look at those. I guess whilst we're waiting to see those come through, one of the things that was raised in a couple of articles I read, particularly around Credit Suisse, were the treatment of hybrid securities in Australia versus Europe.
So to address that issue, so in the Credit Suisse situation, they're additional T1 securities which are subordinate to every form of debt, every form of capital within the bank, with the exception of equity. It had no conversion mechanism. So to deal with the transfer from Credit Suisse to UBS, the regulator, and to basically shore up its capital position, the regulator, since it wanted to deal with them, it couldn't actually convert them to ordinary shares because there was no capacity for them to do it. And so the only option was for them to take a haircut, or in this case, be shorn right off.
Mm-hmm.
So, but in the case of the additional Tier 1 securities issued by our banks, they have a conversion feature to ordinary shares. So if the horrendous event occurred, the additional Tier 1 securities would convert into ordinaries, but there is a ceiling on the number of shares that they convert into, which I think is roughly 20% of the share price at the time that the shares were issued, of the ordinary share price.
Yeah,
is how the maximum conversion number is determined. I think 20% is the right percentage.
Yeah. So that's the case where the hybrid securities, as they're called here, typically pay a income stream for a period of time. So that was in Credit Suisse's case, that was pretty much all they did. And it wasn't a case you get your money back at the end of the day, more like a bond than a.
Well, it wouldn't have had a maturity, so you'd only ever get the income stream. Yes.
Whereas in Australia, that can convert to equity at some point in time, and that gives it more.
Yes.
security.
So the issue when the conversion occurs is actually one of the conditions in the documents is the non-viability trigger that the regulator has. And non-viability is not a defined term. It's determined at the regulator's discretion.
Right.
Which of course would not be taken lightly.
Yeah. Yeah. So do you look at hybrids and those types of securities as an investment option?
No, I focus on equities. I can understand why someone would own them, but I focus on equities.
Would there be a case at the moment that they would be more attractive or less attractive given the environment that you've just outlined for the banks?
Well, you would think in a higher risk environment, they're more problematic. But as I said, I don't. I focus on.
I think from our viewpoint, we often look at, using CBA as an example because they were, pretty big with the hybrids in the early days. If you can earn a really strong franked dividend, which you said is still pretty consistent, which is not too dissimilar to what you're going to get from the hybrid security anyway, even though it's sometimes better at various times as a yield, then it doesn't make a lot of sense really to miss out on the potential upside of equity returns over the long term.
Yeah, it just depends on what your risk profile is, really. Equity is the riskiest form component of the capital structure. So, and then you just pare back as you're heading back to senior debt, the least risky with the lowest margin. You just got to work out where you sit. And your own risk appetite.
None of the banks, it seems, are needing to raise any more capital in a hurry in the short term, so there's not likely to see a lot of those issues.
No, No, that's right. They're in the, what's interesting is they're in the market again, raising wholesale debt. You might have noticed that a couple of days ago, ANZ did a senior unsecured wholesale placement, 3 years, 5 years at on average, I think it was about 100 over bills. It's pretty good, you know, in this environment to do that. It was actually, I think, about 5 basis points below the level that CBA did for a similar term a couple of months ago. So before all this started.
Yeah.
Of course, that issue was domestic. But it does show the confidence that the market has in our banks, and rightly so.
Yeah, that's good. It looks like we've answered all the questions, Brett, so there's no questions coming through.
Okay.
From my viewpoint, I think, you know, what I take out of it, I guess our question was what's been happening with the banks. We've answered that pretty well, I think. Should we be concerned? My take on it, and correct me if I get this wrong, is that not a great deal of concern about further bank collapses or vulnerability, particularly in Australia.
Yeah.
We're pretty stable.
Yeah.
Internationally, there may be some opportunistic sort of buyouts or purchases, but we're not facing a major financial calamity. And the financial system itself, we're not sort of expecting that's going to lock up or have any issues like through the GFC, which is fantastic. But the outlook in terms of the market environment is continuing to, you know, have a few headwinds. Which,
yeah, that's right. That's right.
Yeah.
Something to watch very closely.
Yeah. But, you know, Australian banks are robust, strong, and still delivering on a number of metrics and still good investments in many ways.
Yes, that's right. Well managed organisations.
Yeah. Great. So hopefully at home that allays any fears that you might have had from reading headlines and watching the news with more scary headlines. Certainly something that we continue to watch and will provide feedback on, and Brett is doing it all day, every day. So he's right in the midst of it. And so it's great to have our clients' money in the hands of Brett and his team there looking after us. So thank you for the work you and your team are doing, and thank you for your thoughts today. That was very helpful.
Oh, it's my pleasure.
And everybody at home, thank you very much for tuning in. If you have any questions, please do send them through to your advisor or to me, and we'll be more than happy to get back to you. Otherwise, enjoy the rest of your day. Bye.